The millennials do not bring the upward natural momentum until 2024, and they will peak by 2037, much shorter boom than the baby boomers.
Boomers were like 46 to 64 was a boom generation. There was a Gen X behind us.
Noticeably from 1937 into 61. That's the rising baby boom, which on a lag, predictable, quantifiable lag for peak spending at 46, moving towards 47, would have given us a peak in late 2007. I've been preaching that since the 80s. People back then were saying, Harry, you're crazy. The U.S. is done. Asia's taking over. Japanese make us look like idiots, you know? And I'm like, yeah, they're growing and they're going to grow longer, but we still have the greatest baby boom in the world, and we're going to have the greatest boom in history until 2007, and then it's going to clap.
Who is Gen X and what's their challenge now? Because that's a large generation.
Gen X is the declining birth rates from 1961 into 73 to 75 that caused the slowdown from 2008 still into 2022-23 before the millennials born after them take it up. And even the millennials, here's the important point. Nobody gets this, okay? Even the millennials, with their spending power as a smaller generation, less long in birth, only take us back to where the baby boomers took us. We only get back to even adjusted for rising productivity. We will never see a boom like 1983 to 2007 again in the US, and most of the developed world will never, and Europe's already behind us.
What's going to happen to Gen X? Because they're the sandwich right now. They're the spread.
Well, they're causing the slowdown, but they kind of benefit because when asset prices go down eventually, which they aren't yet, when they do finally crash, they're going to be able to invest at more reasonable prices again and be able to invest for retirement. I tell you, anybody right now in the markets, whether it be bond markets at the lowest interest rates ever, long-term, or stock markets, the highest valuation, if you invest today, even with no predictions of up and down economy, you're likely to make a couple % a year for the rest of your life. You're not going to be able to retire profitably until the markets come down to reality and you can invest at fair asset prices again. This is a new trend everywhere. It's a good trend. People don't have to spend an hour or two commuting every day and sitting in the car. It's only more productive, okay? It's just that the millennials are causing, with less spending than the baby boomers who already peaked at age 46 to 47 before them, they're causing a slowdown. And instead of governments helping to restructure debt, we've got tons of bad debt now from the great boom from 83 to 2007 that needs to be restructured. They're encouraging people to keep that bad debt in place and not to reinvest in new industries and stuff. They're doing all the wrong things because they don't want to have a recession. You know what recession is to me? Sleep. Try not sleeping for 3 days and not become a crazy person. It's already proven. 3 to 5 days, no sleep, you'll become a crazy person. We have to grow and expand all the innovation of the past, and we have to slow again and restructure and cut out losing companies and losing things and reinvest in the future. And governments are interrupting the free market capitalist system that has made us the richest and the greatest advance since the late 1700s in all of history because they don't want to have a damn recession. Greatest boom in history, and just when it needs to restructure, they screw it up so we can never grow again because we never restructure bad debt.
We got through the problem. A lot of it just mismanagement of debt and printing money to solve problems and all this.
All of this stimulus on top of the greatest demographic boom in history, but which did start to fail. So all the stimulus throws money into the economy. What do governments do with this stimulus? They buy financial assets. They start with bonds, but the more money goes in bonds, it will trickle into higher valuation stocks and real estate because that's where the returns are. So what we have now, and I got a number on this, it's close to 600 trillion at 95 trillion. And normally financial assets are a premium 2, maybe 3 times. So the biggest bubble in the world is all financial assets, even bonds. And when you have a crash like this, when these financial assets start to crumble, the money has to go somewhere. It goes into the safest areas. So it is the income producing real estate, multifamily mostly, and it is the treasury bonds, the highest quality government bonds. If the U.S. government can print enough money to keep a dumb bubble going, they'll certainly print money to pay their bonds off, their treasury bonds, okay? You don't have to worry about a default on 30 or 10-year treasury bonds. And again, I go back and say, okay, let's look at 2008. When I look at the 2008 crisis, that was like 1929 to 32 coming in, except this time, massive stimulus, which they didn't do back then. So they come out of it. Okay. But that's when you see things go down, financial assets go down, flirting with deflation. This time we're going to deflate more because they've tried to pump it up and it's failing anyway. So financial assets keep falling. The money has to go somewhere. So it goes into the safest bonds and the highest quality real estate, which is the people, again, the people who are renting real estate, multifamily, the people who will need it more than ever, even people who would rather buy, can't buy in a bad market and hard to get loans. Who's the best house in a bad neighborhood? Is Europe in trouble? Yes. Has Japan been in trouble forever? Yes. Okay. U.S. is still the best house in a bad neighborhood. And our bonds went up in 2008 crisis, 45%. Treasury bonds, 30-year treasury bonds, and they're going to go up more than that this time. So you go to the safest places. Again, where can you get predictable rentals, even in bad times from real estate? And that's from apartments and multifamily. And where are the best bonds that will be paid no matter what, when all financial assets have to go. Now here's my number, from 600 trillion worldwide, they're going to have to come back down to about 250 to 300 trillion. Now, think about that. Globally, 3 times global GDP at 95, $300 trillion, give or take, disappears in financial assets. So as long as you're protected from that in the right real estate and in the right bonds, the highest quality, the longest term. If I could buy one thing, it'd be a 30-year treasury bond.
Okay, U.S. government.
U.S., not Tanzania. Right. Not even Europe. Europe has much worse demographics and already been slower than us. U.S. as a developed country is going to come out of this after a damn near short-term depression, the best. And our millennial generation, Europe doesn't have one, by the way. It's going to be the best in the developed world. So we come out of this better. Our U.S. treasury bonds, 30-year treasury bonds would be my number one right now.
Right. You said something. Why doesn't Europe have a millennial? What happened there?
Because they're older, they've been around longer, they've been richer longer, and people who are rich have fewer kids. Poor people have more kids and rich people have fewer. We should promote rich people having more kids, but the natural propensity, people that have a life say more kids ruins that life, and it's better to have 2 kids and be done. Poor people just keep having kids. When the crash happens, I don't want to hold 30-year treasury bonds at 1 to 2% yields or 0. I want to get back into the best part of the world, and it's not going to be North America anymore. It's going to be better than Europe, but Asia is going to be better than North America and continue to be. There's nothing simpler than demographics than that. We're better than Europe in the developed world, and as things move forward, all the growth is going to be in Asia, East Asia, going towards India, which after I die will be the richest, greatest, largest country in the world.
When interest rates were coming down, the price of bonds were going up or something like that?
Yeah.
Why is that?
Because if you locked in like say a 5% 30-year treasury bond and yields now move down to 2% because of lower inflation, who's worth more, your 5% 30-year treasury bond or the new 2%? Your 30-year is worth a lot more now. So bonds appreciate when inflation comes down, especially long. It is interesting to study other places that have had, inflation and crashes. I mean, I keep seeing people say this is going to turn into hyperinflation. No, it's not going to take much more inflation. It's already crimping our economy and bonds and stuff, and that's already going to lead to a downturn. I'm telling you, when we see this downturn, I think we're already into it. It's already starting now. Inflation will disappear at 9.1% or 10% if it gets the height, and never appear in the rest of our lifetime. That's a forecast.
Wow.
Never see inflation above a few percent for the rest of all of our lifetimes, even if you're 20 years old today. That's my forecast. Because inflation was the major baby boom, and that caused a huge inflation. You know what follows huge inflation? The disinflation and the boom that follows from that generation that caused it, and blah, 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 blah. We're not going to ever worry about inflation in the developed world again. Hey, maybe Zimbabwe, maybe Africa, but we will never, high inflation will never be a topic after.
That's fantastic insight.